Hi everyone, and welcome to my channel. Today I'm going to be talking about taxes and tax strategies for real estate rental property investors. This is a complex topic, but I'm going to try to break it down in a way that's easy to understand. Real estate rental property can be a great way to generate income and build wealth. However, it's aware of the tax implications of owning and operating rental properties. When you own a rental property, you are considered to be a real estate investor. This means that you will be responsible for paying taxes on the income you generate from your rental property. You will also be able to deduct certain expenses related to your rental property, such as mortgage interest, property taxes, repairs and maintenance, and depreciation. Schedule E is a form that you use to report your rental income and expenses. This form is filed with your annual income tax return. On Schedule E, you will report the following: gross rental income, deductible expenses, and net rental income loss. Your net rental income or loss is then carried over to your Form 1040, where it is used to determine your taxable income. There are a number of tax strategies that you can use to reduce your tax liability as a real estate rental property investor. Let's discuss them. One of the most significant tax deductions for rental property investors is depreciation. Depreciation allows you to spread out the cost of your property over its useful life, typically 27.5 years. This means that you can deduct a portion of the property's value each year from your taxable income. For example, let's say you purchase a rental property for $200,000 using the 27.5-year depreciation schedule. You can deduct approximately $7,272 from your taxable income each year. As a rental property owner, you can deduct various expenses related to maintaining and operating your property. These expenses can include property taxes, mortgage interest, and maintenance, insurance, and utilities. For example, suppose you incur annual expenses of $10,000 for your rental property. By deducting these expenses, you can reduce your taxable income by $10,000. If you're considering selling your rental property, you can defer capital gains taxes by utilizing a 1031 exchange. This strategy allows you to exchange your current property for a similar property without triggering capital gains taxes. For example, let's say you sell your rental property for $300,000, realizing a capital gain of $100,000. By reinvesting the proceeds into another rental property through a 1031 exchange, you can defer the $100,000 capital gains tax liability until you sell the new property. Segregation is an advanced tax planning technique that allows rental property investors to accelerate the depreciation of their property. This strategy involves breaking the property's components into different asset classes with shorter depreciation timelines, such as personal property with a 5-year or 7-year depreciable life, compared to the building structure's 27.5-year depreciation schedule. For example, let's say you purchase a rental property for $200,000, with the building structure accounting for $150,000 and personal property valued at $50,000. Under the standard depreciation method, the building would be depreciated over 27.5 years, while the personal property would be depreciated over 5 years. However, with cost segregation, you could depreciate the personal property significantly faster, leading to larger depreciation deductions in the early years of ownership. Understand and strategize around passive activity loss rules, which may limit the ability to deduct losses from rental activities. Active participation or meeting certain criteria can allow up to $25,000 in passive losses to be deductible against other income. Carefully evaluate your material participation in your rental property activities. If you don't materially participate, consider strategies to increase your involvement to benefit from the special allowance. Carrying forward unused losses is a tax provision that allows real estate investors to deduct losses from their rental properties in future years if they cannot deduct them in the current year. This can be beneficial for investors who have a lot of expenses in the early years of owning a property, such as mortgage interest and property taxes, but do not have enough rental income to offset them. Let's say an investor purchases a rental property for $100,000 and incurs $15,000 in expenses in the first year. However, the investor only has $10,000 in rental income. This means that the investor has a $5,000 loss for the year. Under the carrying forward unused losses provision, the the investor can deduct this $5,000 loss in a future year when they have more rental income. There are a few things to keep in mind about carrying forward unused losses. The losses can only be carried forward to future years, not back to past years. The losses can only be deducted against passive income, which is income from rental properties or other activities in which the taxpayer does not materially participate. The losses are subject to certain limitations, such as the $25,000 allowance and the phase-out rules for adjusted gross income. If you use part of your home exclusively and regularly for your rental property business, you may be eligible to claim office deduction for related expenses. Explore tax credits available for energy-efficient improvements or renovations made to the rental property, such as installing solar panels or energy-efficient appliances. For eligible real estate investors, the qualified business income deduction under the Section 199A provision can allow a deduction of up to 20% of qualified real estate income from a pass-through entity. When it comes to strategizing for long-term and short-term capital gains in real estate for tax purposes, it's essential to understand the timelines. Long-term gains, typically from properties held for over a year, often come lower tax rates. To optimize this, consider holding on to properties for more than a year before selling to benefit from reduced tax liabilities. On the other hand, short-term gains from properties sold within a year of acquisition are taxed at ordinary income rates. For short-term gains, strategic planning might involve offsetting gains with losses, utilizing 1031 exchanges to defer taxes by reinvesting in similar properties, or considering ways to optimize deductions and expenses related to the property sale. Tax planning is an important part of real estate investing. By understanding the tax implications of owning and operating rental properties, you can develop strategies to reduce your tax liability and maximize your